Shut up and sit down.
All right, everybody, welcome back to the Rebel Trading Group podcast, episode 55. Today, your host, the gluten-free Jason Bessing. What's going on, everybody? It is Thursday, December 20th. Pushing close to Christmas here. December 20th, 2018. Market closed about an hour and a half. I'm going to start with the cryptos today. Cryptos are having a beautiful day. Bitcoin up 10% above the 4,000 mark for the first time in a little while. 4,066 is what she is sitting at. Altcoins doing even better. Ethereum back at 113, Litecoin at 32. Not bad moves in the crypto markets. However, in the equities markets, getting wrecked on the Dow, 464 points. That's a pop up. We were down about 600 at one point. S&P's down, I'm going to call that 39.5. NASDAQ down 108. Gold, nice slight move up, $7 there. That's big for gold, by the way. That's very big for gold. And oil getting hit again. Down to $46 a barrel. Absolutely wrecked in the oil markets. And one of my core holdings, I wouldn't say core, one of my holdings is an oil energy company, Chesapeake. And she's not doing so well. So thoughts and prayers on that one. Let's go on to the market news. Obviously, we know that these rates have been hiked. Came out yesterday with another quarter point raise from the Federal Reserve, making all debts across the nation a little bit more expensive. And on top of that, we have had a humongous sell-off as a result. So the Dow has just been, it's been real painful to watch. At 22,859. When just several months ago she was at 2,072, I think. 272 is about 27,200. And we're significantly down. Down, I'd say, about a bear market. About 20% from that. Definitely. But what does that really mean? Just because it went down 20%, does that mean it's the end? Or it's the end all be all? Oh, 20%, this is the bear market, it's over. What if we rallied for the next 5 weeks on the winds of some other trade deal or some other arbitrary news that just moves the day-to-day hedge fund money? It could be a number of things. So that's the biggest news driver. That's what everybody is kind of looking at right now across the globe. Very quiet around Christmas time. Politics are going back and forth. General Mattis is going to retire as Secretary of Defense in February. So we lost the Attorney General, Secretary of Defense, Chief of Staff. Interesting stuff going on in the political world, in the financial world, the banking world. And we've had a humongous sell-off as a result. And that's basically your news. Unless you live under a fucking rock, you just know that the market is just getting absolutely pummeled right now. We're going to talk about 4 things that you can do, 4 plays that you can make in this exact market. But first, I want to go over to your market terminology. I like to always throw out a word, maybe 2, a couple of words, so that you can get through the lingo and the jargon of Wall Street, because that's all it is. So today's market terminology, I want to say, I've done it before, but it's another one of my favorites. It's a preferred stock. Now, what is a preferred stock? Well, in order to understand preferred stock, you've got to understand the hierarchy of the note holders within a corporation. And basically, on the top level, you have your bondholders. And bondholders, remember, issue debt to a company. They loan money to the company in exchange, get an interest rate. Dividend paid back however many years that the bond is. Then you have your stockholders, which don't give money to borrow, but instead own pieces of the company, so they get the profits. So rather than being paid off, they collect the profits in the company. And with that has much more potential for higher returns. Now, that being said, there's a middle hybrid of the two, and these are called preferred stocks. Now, preferred stocks are mostly issued by banks, and to be honest, I've only seen them issued by banks. A preferred stock is a hybrid between a bond and a common stock. And what the preferred stock is let's just say the share is issued at $25 and it's going to pay 5% a year for 3 years. Well, if that company decides that it has to declare bankruptcy, all the money after the sell-off of all the assets is going to go to the bondholders. What's left after that is going to go to the preferred shareholders. And what's left after that will go to the actual equity shareholders. So a little bit safer than stocks. I don't want to say safer, but a little bit safer. They don't move like a stock does. They do fluctuate in value, but they're more tied to interest rates in bonds than they are performance of a company. Because that preferred stock doesn't get any rate of return bigger than what is already declared. So it's not going to get money from blowout earnings and stuff like that. And basically they're income instruments. It's ways to just get cash flow, secure cash flow back into the account. If you want exposure to preferreds, or sounds something like you might like to get interested in, one of my favorite ETFs is PFF, and that's the Preferred Fund Index, and it pays about a 5% dividend. It's currently dipping and will continue to dip as interest rates go up. And that being said, that dividend is paid out monthly, and yes, I'm going to say it is safe. It is about 99.99% safe. But it's not going to move on you. That's the only thing. It's not going to rocket up to $45. It will fluctuate in value, but it will not move. You're looking for dividend plays and income. Perfect vehicles for retirement, but not something that the Rebel Trading Group personally is involved in. So today, let's talk 4 things that you can do in today's market on when the market opens December 21st, Friday, tomorrow. You can implement some of these plans. Let's start with number 1. Number 1, you can get out. You can go to cash. You can put on your stop losses. You can sit on the sidelines, and we can watch. I don't really like that plan. Will it work? Yeah, probably. You'll probably save a little bit of money. I'm not a fan, though, because at that point you're trying to time the market. For all we know, we could be at the very bottom, and we could have a huge 500, 600-point rally end of the week, end of the year. We could have that magical Santa Claus rally. So I'm not really a fan of doing that. But if you are losing your stomach in this market and you have a portfolio or cushion to protect, going to cash on some of your more volatile things may be a good idea. And if you're going to go to cash, I would wait at least 2 to 3 weeks to see any confirmations before coming back in. Number 2, we could put on a few hedges. We could put on some shorts. We could do a few inverse ETFs if you'd like. We could do some put options. We can sell some covered calls for a little income. We could do anything that's going to kind of short. And this will be a good hedge to the portfolio in case of more turbulence ahead. I would recommend about 5 to 7% if it's something that you want to do. 5 to 7% of the portfolio, maybe in like an inverse S&P fund like SH, or maybe a gold fund, GDX. You could play gold, something like that. Something that's going to hedge it. I kind of mentioned my next third move, which is not shorting, but hedging, which would be something like we could reallocate to a more defensive portfolio. We could go to utilities. We could shift over from your XLKs over into your utilities, XLP, your staples. A lot of big blue chips are now on sale. Those big, strong dividend payers. The stocks are broken. The companies are not. I'm telling you. So you can hedge against some of those bigger companies, you can hedge with some of those blue chip recession-proof companies. Get out of the cyclical stocks. Get out of the automotives. Get out of the energy. Get out of technology. So you could reallocate to a defensive position. We could put on a few shorts. We could get out and try to time it. Or my favorite and the last point that I'm going to make is we can buy the fucking dip. And that's what I'm doing. It's very painful. Absolutely. But I'm seeing a lot of things that I like. And I try to be as transparent as possible on this show as not to hide behind any sort of sketchery and all talk, no game. One of my favorite positions is and always will be Ford. Because of that dividend, its sustainability, I'm a huge fan of the company. I'm a huge fan of the history of the company. I'm a huge fan of the products. I just love everything about Ford, including the stock. And I picked up some at $8.32 today. And when I first started trading, she was at the $13 range and still paying a 4% dividend. So that is one that I accumulated. So we can continue to buy some of our favorite stocks, some of the things that have got hit pretty horribly, but we have a long-term outlook on. And Ford is one of my 20-plus year holdings. So seeing it go on sale just time and time and time again, I'm actually getting excited. One of my good friends called me yesterday, and we're talking about the horrors that are currently within the stock market and just watching it go down. Nathan, just a few days ago, said it's like getting hit with a baseball bat over and over. And that's exactly what I'm feeling. My buddy calls me yesterday, and he says that you need to not look at it in percentages and losses, but you need to look at it as how many shares you're accumulating for these prices. I think that's a great way of putting it, because when these markets turn around with those other three strategies, you'll have been too late. But with that fourth strategy, the buy the dip, when the market turns around, you're already there. You've been ignoring market conditions. You've been continuing to accumulate strong companies with strong financial backing, strong dividends, strong cash flows, strong revenues, strong management. Those are the ones that we're buying. And we're going to continue to load up on them. Every 2-3% they drop, we're going to buy a little bit more. We're going to buy a little bit more. We're going to buy a little bit more. And we're going to keep adding on. If you're trying to time the market, by the time it's already bounced on that first option, going to cash, you have to retime yourself getting back in. You've missed it. Number 2, you put on those shorts, market turns around, those hedges are now losing money. Out. Utilities, same thing. Once the market turns around, utilities, consumer staples, out. But you buy the ones that you love, and you have a nice portfolio across your favorite companies, and the market turns around, and we start to have those consistent green days on the Dow, because they will come. 8 green days in a row, 9 green days in a row. We've seen it. It happens. It's going to come one day, and I want you to already be there. So when you buy these companies, of course, you can sell the covered calls on them. That's my favorite strategy, especially in a very turbulent market when implied volatility is high and premiums are high. So, to recap, Sorry, drinking a little bit of Merlot during this episode. To recap, in this market, this turbulent market that we are currently in, 4 plays you can make. And this is, of course, if you have an ideology that mimics the Rebel Trading Group and the swing trading and value investing with buying on strong chart patterns and so on and so forth. If you're a normal day trader, you don't care about the current market conditions and you just care about what the market's going to do in the next hour or few hours. I'm talking about for the next 6-month term. You can implement one of these strategies. You can go to cash. You can park it on the sidelines. You can get out of some of your more volatile things. We can wait it out. Nothing wrong with riding out the storm, especially if you've got a big cushion to protect. You got to protect a good $400,000, $500,000. I get it. I don't have that kind of money to protect, so I'm getting a little more aggressive. You can try to put on a few shorts. You'll make a little bit of money if the market continues to dip. It'll also be some insurance. Don't over-lever yourself. Don't over-allocate yourself. Don't go too heavy in the shorts, because when the market comes down, those shorts they'll leave you with your shorts around your ankles. Number 3, we have you can reallocate more defensively, which is one of my better options, because you're going to be able to stay in the market at that point. You'll be able to stay in the market. And last but not least, we can just continue to buy the dip. And this isn't an option for everybody, but I do contribute money to my trading account weekly so that I can have exposure to buying dips where I see fit. Every week, one of my favorite stocks is on sale at some point. One of them is. So I allocate money accordingly. So that was a quick episode. I wanted to just get something out there. Might not be able to bring you anything tomorrow, so I wanted to wrap it up. We're going to definitely try to do a nice episode on Christmas Eve. I think that would be nice. I think that'd be a fun episode. I feel like a little bit of whiskey or a little bit of wine is going to have to be involved in that one too. Maybe we'll have something special. A long episode, maybe we'll have on a guest. I don't know. That could be a fun one. I'll get with Mr. Nathan to see what he wants to do. To wrap this up, I'm going to go with one stock that I'm watching for the rest of the week. And I'm going to continue to watch gold. And more specifically, we're going to pop over to JNUG. That is the Triple Leveraged Junior Gold Miners Index. I like JNUG, J-N-U-G, as a gold play because of its leveraged nature and that it is in reflection to gold miners. Gold miners move before the gold prices do. If gold is doing, it's just like oil. If the price of oil goes up, oil companies do good. If the price of gold goes up, gold companies do good. So they're a little bit more aggressive. So we had a monstrous move up in the past week, moving from all the way down 724 and currently sitting at 828. So $1.94. $1.04 per share. Over 13, it's about 14% gain. Now, it is leveraged, so that is one thing you got to be careful of, but this is one of my favorite gold trading vehicles, and I'm going to continue to watch it because she had a strong push to 927 yesterday, right at market open, and then plummeted the rest of the session. So I'm going to continue to watch JNUG. I want to see if she can push back to the 9. Maybe even sell the 9 covered call. End of week. Maybe end of next week. Ooh, yeah, end of next week. That way you can get that Christmas Eve theta on there. I like those ideas. So, continue to watch JNUG. We're watching gold. Market terminology was PFF, your preferred shares. If you want to be on the show, or if you have an idea for a logo, email us, rebeltradinggroup@gmail.com. That is our email. It's the best way to reach us. We are on YouTube. All of our prior episodes and a full archive of them will be on YouTube for you for free forever. We are on SoundCloud. We are on Apple iTunes now. Watch us, just listen to us from your iPhone. Our newest few episodes will always be on iTunes, but our full archive, like I said, is at YouTube or SoundCloud, iTunes, Facebook, Stock Twits, and once again, the email is rebeltradinggroup@gmail.com. That's rebeltradinggroup with 2 G's at gmail.com. Thanks for listening, guys. Thanks for the quick episode, 20 minutes of your time. I love you guys. I'm out.
Shut up and sit down.